How are we all doing? Hey guys, it is Mrs. Invest. So you've probably noticed that the stock market is down quite a bit recently, and it's caused a lot of widespread fear and panic selling. And although I've made a video in the past called How to Not Panic During a Stock Market Correction, which I'll link below, I've never actually made a video about a stock market correction during a stock market correction, and this seems to be what everyone wants to talk about right now, so I figured I just had to do a video on it. So today I'm going to offer you some words of encouragement to get through this period, talk a little bit about what is actually going on in the market, what factors have led to the correction that we're currently experiencing, and things you can do to better position yourself to get through times like this, especially if this is your first correction experience. You know, there's a lot of new DIY investors since 2020, and this may be really the first time that you're experiencing a downturn, especially if you've bought recently. And believe me, spoiler alert, it is okay. Everything's going to be fine. So let's get right into the video. So yes, the market is down, but overall the total market, US and Canada, is not actually down that much. Now, remember, a bear market is defined as when we are down across the board 20%, and that 20% decline lasts for at least 2 months. So right now, the S&P 500 is down about 16% from its recent highs, and the Canadian total market is down around 10-11% from its recent highs. But the technology sector has definitely been hit the hardest. So the NASDAQ is down about 26%. Tech names have just gotten absolutely crucified recently, but outside of them, the whole market is definitely experiencing a correction, but we are not yet considered to be in bear market territory. And although there's a lot of widespread fear and panic right now, it's important to just sit down and look at the numbers and realize that although it has happened quickly, so it feels like a lot, we really are not in that big of a correction. There has been a much larger corrections before, and as usual, the markets have rebounded. It's definitely a good thing to think about of why this has happened in the first place. So back in 2020, when we had a crisis, a lot of money was printed and injected into the economy to save the economy because nobody was working, businesses were closed, and we needed to do something to prevent full economic collapse. So the US Federal Reserve injected $1.9 trillion into the US economy, and more money has been printed in the last 2 years than any other period before in history. So you cannot just print infinite money. Eventually you are going to suffer the consequences of doing that, and we're kind of in that period right now. So although injecting all that money into the economy sort of saved us over the last 2 years from economic collapse, now we're dealing with record inflation. You can't let inflation get out of control, and I'm sure we've all felt it with gas prices and food prices getting out of control. So there has to be some kind of monetary policy to rein things back in. And so where we are right now is the US Federal Reserve and the Bank of Canada are trying to increase interest rates at a slow enough rate to not send us into a full-blown recession, but they realize that they have to increase the rates so that we can combat this record inflation that we're experiencing. So how does that relate to the stock market? Well, the stock market is always forward-looking, and it's like a scared little animal. Any changes that go around, it tends to react in a very exaggerated way, especially to negative news. Think about it. We're just getting the rates back up where they need to be to get inflation and the economy back under control. So everything that's happening with monetary policy is good. It's just the stock market is scared and doesn't like change. So that is why I'm very confident that everything will even out and rebound and settle back to normal. This is just an overreaction of fear due to tightening monetary policy. Now, you can if you want to know more sort of about what's going on with monetary policy, I'm sure there's lots of videos on YouTube that talk about it for 3 hours, but that's kind of the gist of it, to explain it very simply of what the heck is going on right now. Regardless of what's happening with monetary policy in the stock market, there has always been volatility and there will always be volatility. The stock market goes up, the stock market goes down, and it goes up more often than it goes down, but there will be periods where it goes down. And honestly, if you are still adding to your portfolio and you're in a growth stage, the extremely green periods are kind of boring because there's nothing really to do. You're not selling. It's the corrections that I find the most exciting because it allows me to add the names that I already know and love at a discount. And this really is an important thing to talk about, which is you have to understand why you are investing in the things that you are investing in, not because someone told you to or you're following somebody else. And it's one of the reasons why I really hesitate recommending specific investments, but rather I like to show you guys how to think so you can think for yourselves and pick the best stocks or ETFs that you think will be right for you. The problem really comes in when somebody buys a stock, they don't know why they bought it, and then the stock goes down and they don't know what to do. These are the situations when people will typically panic sell during corrections because they have no underlying conviction in the reason why they bought that stock in the first place. And so when it goes down, they just panic and they just want to end the anxiety and they sell to preserve what they have left. But if you really have your own thesis for the individual stocks that you invest in and you believe that they're going to be good businesses over the short, medium, and long term, and you've invested in them, then the down periods just give you an opportunity to pick up more shares at a discount. And if you don't want to go through all the trouble of picking individual stocks, then there's always the opportunity to invest in the broad market, in the Canadian broad market, in the US broad market, and in the S&P and international as well. And I have a lot of videos on my channel about that. And it really frees you up from having to pick individual stocks. You are betting on the overall market, and it's pretty hard to argue against the fact that overall the stock market will go up in the long term, but it's not going to be a straight line. There will be volatility and there will be some corrections and downturns. So let's look at a couple of statistics from the last 200 years of the stock market as far as downturns and corrections and how many there have been. It may surprise you. So this bell distribution here shows average US annual returns over the last 200 years. And I want you to look over to these last three columns, which represent losses for the year of greater than 20% or more. Now, this is a pretty small handful of years over the last 200, and two of the years were 1931, which was the Great Depression, and 2008, which was the global financial crisis. So other than those 2 years, there's really a very small handful of years here that represent a negative 20% loss or more. And this is one of the reasons why panic selling is generally a really bad strategy, because typically when you start to consider panic selling, you're probably somewhere here, maybe in the 0 to negative 10 range, or maybe you're already beyond the negative 10 range. Maybe the market's gone down 15%. So if you sell when we're in these two bars here, it becomes increasingly unlikely that the market is going to continue going down because you would be in these three bars here. And as we can see, this doesn't happen that often. So typically what happens then is you end up selling for a loss out of panic, and then the market rebounds over here and you end up having to buy back in higher. The other thing I want you to see is if you compare similar columns but just flip the negative and the positive. So for example, compare this negative 20 to negative 30 to the positive 20 to positive 30. There are way more years where the market has been up 20 to 30% than years where it has been down negative 20 to negative 30%. So as long as you know that this market volatility will happen, there will be corrections. You don't know when they're going to happen, but as long as you know to expect them, then you're good and nothing can really worry you because you were expecting it. And a good rule of thumb is on average, a correction will happen once every 2 years, and that's where the market goes down about 10%. So that's about right here. And on average, a bear market will be about every 7 years, and that's where the market goes down 20% or more and lasts for at least 2 months. And when you're talking about a full-blown crash of 30% or more, we typically see that once every 12 years. But of course, these dates are just averages, and you can never predict when they're going to happen. But the key is really knowing to expect them so that they don't surprise you and being able to handle them emotionally well. And as you learn how to invest and do your own investing, you really need need to get comfortable with risk. And I've talked about this in my Investing 101 video. Risk is your friend. Risk is what allows you to make money, but there's a difference between calculated managed risk and then gambling. Those are two completely different types of risk. So what you need to do is to understand the risk so that you can manage it and mitigate it. And with any investment, whether it's putting your money in a savings account, real estate, or the stock market, there is risk across the board with any investment. You know, people say the stock market is risky, and yes, that's true, because it's very easy to liquidate your assets in comparison to other types of investments. You know, it's really difficult to quickly liquidate your home and sell your home. It's a big headache, so people generally don't do it. But with the stock market, you can sell at any time, and so I think we are the biggest risk to our own portfolio rather than the stock market being risky itself. The returns in the stock market across the board for the broad market have been excellent for the last 100 years, as long as you've held and continued adding throughout the years. This is a really good opportunity to check in with yourself, especially if you're a fairly new investor, at how the volatility has personally affected you and made you feel, because we may think we know how we will react to a market downturn, but sometimes how we think we're going to act is not actually how it affects us. So, you know, if you're feeling really nervous and sick to your stomach, and you're having a lot of anxiety and having a hard time sleeping, maybe it's time to reevaluate your asset allocation, or maybe it's because you have invested in speculative investments that you wish you hadn't had bought in, or maybe it's because you are using borrowed funds and you're worried about getting margin called. So if you are feeling nervous, kind of try to narrow in what the reason for that is, fix it so that the next correction you will feel much better and be able to sleep at night and ride through it without having those same type of feelings. So that's it for today. I hope this video made you guys feel better. Let me know your thoughts on this whole correction and what's happening below. You know, do you think we have more to fall? Do you think we've already reached the bottom? I'd love to hear your thoughts. I have no idea at all. I don't make short-term predictions. Nobody knows. I'm just along for the ride. So I'll see you guys in the next video, and I look forward to reading your comments. Bye.